Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalysts talk. Today we're looking at BlackBerry.
If you find our talks useful, please consider subscribe, like, and comment underneath. Because before we even get into the numbers today, let's just address the elephant in the room.
Oh, the hardware thing.
Yeah, exactly. I mean, when you hear the name BlackBerry, your brain almost certainly time travels straight back to 2010.
Right.
You think of that clunky smartphone, with the tiny plastic keyboard clicking away in a boardroom. It feels like a relic.
It really does to most people.
Yet, the stock is currently breaking out to fresh 52-week highs. It's pushing up near $10.78.
And doing it on massive volume.
Unusually massive. We are talking about 97 million shares trading hands in a single session, triggered by a major government security certification. So it is major cognitive dissonance to see a so-called legacy hardware company trading with this kind of, aggressive modern momentum.
It is. And before we break down exactly why the market is suddenly pricing in a completely new identity for this company, here is a useful chart tool for investors and traders.
Yeah.
If you want help reading trading charts more clearly, you can check out VIP Algos through the link below in the description. VIP Algos is a TradingView indicator suite that shows visual buy and sell chart alerts, trend direction tools, support and resistance zones, and take profit and stop loss planning areas.
Super useful for visualizing the setups.
Exactly. It can be used across markets like stocks, forex, crypto, gold, indices, futures, and more. Just remember, VIP Algos is an educational chart analysis tool only. It is not financial advice.
Right, it doesn't place trades for you.
No, it doesn't, and it does not guarantee profits. Trading involves risk, so always manage your risk and do your own research. Also, this is an affiliate link, so we may earn a commission if you use it, and no extra cost to you.
So getting back to that cognitive dissonance, 97 million shares don't just trade hands for nostalgia.
Definitely not.
If we are evaluating this for long-term portfolio growth rather than just a quick day trade, we really need to understand the macro shift happening under the hood. Like, what does this company actually do in today's economy?
Well, the hardware era is completely dead.
Gone.
Completely. They have entirely pivoted into a high-margin software entity, specifically positioning themselves at the very center of the physical AI and robotics evolution.
Okay.
When investors look beyond the short-term momentum of the chart, they are looking at a structural turnaround profile. They're providing the underlying safety software that allows machines to function in the real world.
Let me put an analogy to this, because physical AI is a term that gets thrown around a lot. I like to think of this artificial intelligence revolution like a human body.
Oh, I like that.
Right now, Wall Street is entirely obsessed with buying the brain. Those are your massive large language models, the heavy data centers, the generative AI platforms that write code or generate images.
Right, the flashy stuff.
Exactly.
Yeah.
But a brain cannot interact with the real world without a nervous system. The brain might decide to move a muscle, but the nervous system has to fire the exact signal at the exact microsecond without fail.
Yeah.
That is what BlackBerry is building. They're building the nervous system, the safety-certified, ultra-low latency reflexes needed to operate industrial robots and autonomous vehicles safely.
And the stakes of that physical edge environment are fundamentally different from a chatbot.
Oh, absolutely.
If a cloud-based AI brain hallucinates or misfires, you might get a weird response on your screen. You just refresh the page and you move on.
No big deal.
But if the nervous system in a 2-ton autonomous vehicle misfires because the software lags for half a second, the car crashes.
Yeah.
If an industrial robotic arm welding a chassis in a factory takes a full second to register that a human worker just stepped into its path, it is a catastrophic failure.
It's life or death.
Literally. The reliability required at the physical edge is astronomical, and they have cornered the niche of providing the deterministic operating system that prevents those failures.
Okay, we are talking about nervous systems and robotics, but, Wall Street doesn't price a stock entirely on a cool metaphor.
Fair point.
A great narrative needs to be backed up by actual cash coming in the door.
Yeah.
Are they actually monetizing this software pivot, or is this just theoretical growth?
No, the recent Q4 fiscal 2026 earnings provide the first real validation of the turnaround narrative.
Okay, what are the numbers?
They posted revenue of $157.96 million. That represents a 10.1% year-over-year growth, which actually beat Wall Street estimates.
Oh, wow. Cool.
But the broader revenue number kind of masks the real story. When you look specifically at their Internet of Things segment, which houses that QNX robotics software, revenue jumped 20% year-over-year.
20%.
Yeah, up to $78.7 million.
So the legacy parts of the business might be flat, but the specific nervous system software we just talked about is growing at 20%.
Exactly.
What about the other side of the software pivot? Because they do secure communications as well, right?
They do, and their secure communications unit delivered 8% year-over-year growth. That brought their annual recurring revenue up to $218 million.
That's solid.
It is. In software valuation, recurring revenue is highly prized because it creates a predictable cash flow floor. They are actually nearing what the industry calls Rule of 40 performance in that specific segment.
Let me stop you there and just unpack the Rule of 40 for anyone not, elbow deep in software valuation metrics.
Sure, go ahead.
The Rule of 40 essentially says that if you take a software company's growth rate and add its profit margin, the total should be 40% or higher. It is considered the holy grail metric because it proves a company isn't just setting cash on fire to buy artificial growth.
Right. It shows sustainable scaling.
But here is where I have to play the skeptic. Turnarounds are notoriously lumpy. A legacy company posts one great quarter and everyone cheers, but we really have to ask, is this cash flow a permanent new reality? Or is this just a temporary spike from a one-off government contract artificially inflating the numbers?
Well, consider the underlying mechanics of who is actually paying that $218 million in recurring revenue.
Okay.
This isn't a consumer subscription that gets canceled when household budgets get tight. Government agencies and massive enterprises do not just rip out their highest security communications platforms on a whim.
Right, the headache of doing that would be huge.
The switching costs are astronomically high. To tear out a foundational security layer, retrain an entire global workforce on a new system, and migrate classified data is a multi-year, multi-million-dollar nightmare.
So they're locked in.
Because those switching costs are so prohibitive, that cash generation has a very solid floor.
And their balance sheet reflects that stability right now. They're sitting on a current ratio of 2.12.
Which is very healthy.
Yeah. For anyone following the fundamentals, a current ratio of 2.12 means that for every single dollar of debt or liabilities they have to pay over the next 12 months, they have over $2 in liquid cash and assets sitting in the bank.
Exactly.
They also have an incredibly low debt-to-equity ratio of 0.26. In a macroeconomic environment where interest rates are punishing companies that rely on heavy borrowing, they generated $44.4 million in free cash flow without needing the bank.
Which management is using aggressively, by the way.
Okay.
They are funding a massive share buyback program.
Wait, really?
Yeah, authorizing the repurchase of up to 26.8 million shares. When a company uses free cash flow to buy back its own stock, it is signaling to the market that management believes the shares are severely undervalued. But, the financial metrics only exist because of the underlying moat. That QNX operating system is already embedded in over 275 million vehicles globally.
That's a massive footprint.
And furthermore, their critical event management platform, AtHoc, just secured a 2026 FedRAMP Class D high-risk certification.
Right. That certification was actually the spark for that 97 million share volume day we talked about at the top of the show.
Yes, it was.
Why is a Class D high certification such a massive deal?
Because it makes them the only cloud platform approved at the U.S. government's absolute highest security level for unclassified data.
The only one.
The only one. When you achieve that level of federal clearance, you essentially lock out smaller competitors who just cannot afford the years of auditing and millions of dollars required to get that certification. The Pentagon and federal emergency systems rely on this infrastructure.
So they have the cash, the balance sheet, and the security clearance.
Yep.
But Wall Street doesn't hand out 52-week highs just as a reward for past performance.
Yeah.
The market is forward-looking.
Always.
What is the actual trigger event on the calendar that forces the market to reprice this stock next?
The immediate focal point for the entire market is their upcoming fiscal Q1 2027 earnings report on June 25th. Institutional investors are going to be laser-focused on one specific metric, and that's the QNX royalty backlog.
Okay. A backlog.
Currently, that backlog sits at a staggering $950 million.
Nearly $1 billion in contracted backlog.
Yeah.
But let me ask a practical timing question at how that actually works. How fast does a $950 million backlog actually hit the income statement?
That is the million-dollar question, or billion-dollar question.
Because if it takes 15 years to realize that revenue, the current valuation breakout is going to be very hard to justify. Is June 25th a make-or-break moment for this new stock price?
The timeline is dictated by the automotive and industrial manufacturing cycles. When they win a contract for QNX, that is called a design win.
Yeah.
The automaker then spends 2 to 3 years actually designing and testing the vehicle. The royalty revenue doesn't hit the income statement until that specific vehicle physically rolls off the assembly line.
Got it. So it takes years.
So June 25th is not about recognizing all $950 million at once. It is about proving the trajectory. Wall Street needs to see the conversion rate accelerating.
Showing that the cars are actually getting built.
Exactly. If management can show a meaningful uptick in the royalties actually being realized today, the market will confidently and aggressively price in the rest of that massive backlog.
Aside from the June 25th earnings, there are other catalysts stacking up. We are seeing a heavy executive presence at major tech conferences coming up, both CIBC and Baird.
Right.
Plus, they have highly anticipated robotics demonstrations scheduled at the Robotics Summit. You combine that visibility with the global macro tailwinds right now. We are seeing rising defense spending across the globe and a massive push for digital sovereignty.
Absolutely.
Where countries want their critical software infrastructure secured within their own borders.
And all of those fundamental drivers are converging right as the technical chart is violently shifting.
The price action has been wild.
Yeah.
Let's map out what is actually happening on the chart.
The chart has formed a relentless staircase higher pattern over the last month. In mid-May, the stock was quietly grinding in the $6.10 to $6.30 range.
Yeah.
Fast forward to early June, and it has aggressively re-rated, pushing up toward that $10.78 level. We also saw a golden cross trigger in May.
For those who don't trade technicals daily, a golden cross happens when a short-term moving average, specifically the 50-day moving average, crosses above a long-term moving average, like the 200-day.
Right.
It is widely viewed by technical traders as a definitive signal that a stock has broken out of a structural downtrend and entered a new long-term bull phase.
The momentum pushing that golden cross has been characterized by relentless dip buying. However, it is now pressing directly into a major breakout ceiling at the $10.93 resistance zone.
Which is tough to break.
And this is the most critical technical detail to watch right now. The relative strength index, the RSI, is sitting at 89.91.
Let me jump in here because anyone listening who watches charts knows that an RSI of 89.91 is practically flashing neon warning signs.
Oh, definitely.
The RSI measures the speed and change of price movements on a scale of 0 to 100. Anything over 70 is generally considered overbought. Hitting nearly 90 means the stock is stretched like a rubber band pulled to its absolute limit.
Exactly.
The buying pressure is largely exhausted in the immediate term.
And when momentum gets stretched to that extreme, it historically leads to very fast, violent pullbacks the second that early buyers decide to take their profits.
Yeah, people want to lock in gains.
Right. If the stock rejects at that $10.93 resistance zone, the next major structural support level is all the way down at $8.01.
Which emphasizes exactly why caution is necessary. A golden cross is a fantastic long-term signal, but buying at an RSI near 90 means you're playing with fire in the very short term.
You really are.
Charts show probabilities, they do not offer guarantees. Honestly, this dynamic is precisely why disciplined traders use tools to map out their take-profit and stop-loss zones before they ever enter a position.
Exactly.
If you buy a breakout without a mathematical plan for where you will cut your losses if it reverses, you aren't investing. You're just gambling.
The structural turnaround story is highly compelling, but the immediate entry point carries significant technical risk. This creates a volatile environment, which is perfectly reflected in how polarized the broader market sentiment is right now.
The sentiment is incredibly fractured. You have this bullish structural euphoria completely clashing with short-term technical caution.
Yeah, it's a real tug of war.
On the retail side, interest is absolutely exploding. Message volume on StockTwits was up 1,365% over the past 3 months. The retail traders are swarming the momentum.
But the most fascinating dynamic is the severe disconnect happening between Wall Street analysts and the company's own corporate insiders.
What's going on there?
Well, CIBC recently raised its price target to $8.50, which is relatively bullish, but the broader consensus target among mainstream analysts is sitting all the way down at $4.88.
We have to highlight this glaring contradiction. The consensus analyst targets imply a massive 59% downside from where the stock is trading today.
Right.
Yet, look at what the insiders are doing. On May 31st, 7 different company directors acquired deferred share units. They aggressively accumulated shares, perfectly timing this current breakout run. What does Wall Street think it knows that the company's own board of directors is ignoring?
It comes down to how different groups measure risk. Wall Street analysts are inherently looking in the rearview mirror. They are evaluating the current valuation multiples and remembering the company's legacy execution missteps over the last decade.
So they're waiting for proof.
Analysts are notoriously slow to update their financial models. They wait until the cash is literally sitting in the bank account. Insiders, on the other hand, are looking through the windshield.
They see what's coming.
Exactly. They see the $950 million backlog. They know the specific details of the FedRAMP certification. And they know exactly what the contract pipeline looks like for the next 3 years behind closed doors.
And it's worth noting what a deferred share unit actually is. These directors aren't just getting handed free cash.
No.
A DSU means they are deferring their compensation into phantom stock that tracks the company's share price. And crucially, they usually cannot cash those units out until they leave the board of directors.
Because they're locked in.
It is the ultimate skin in the game. They are locking their own financial compensation into the long-term future of the share price. And hovering over all of this insider buying is the speculative retail chatter that this company might be a prime acquisition target.
Oh, the buyout rumors.
Because they own the foundational safety layer for physical AI, the theory is that a massive semiconductor conglomerate might just buy them out entirely to own the ecosystem.
While buyout speculation is always present in turnarounds, investing based purely on that hope is dangerous. The risks here are very real, and ignoring Wall Street's caution entirely is a reliable way to lose capital.
So what are the biggest risks?
The biggest fundamental risk right now is the extreme valuation multiple. We're looking at a price-to-earnings ratio near 130 and a price-to-sales ratio of 11.1.
Let me translate that PE of 130. It means that, at the current price, investors are willing to pay $130 today for every single dollar of profit the company generates.
It's steep.
That means the stock is practically priced for perfection. Traders are aggressively paying up for years of future growth before it has happened.
And if the QNX execution falters, or if that massive backlog conversion is delayed by supply chain issues in the auto industry, the stock is highly vulnerable to a severe multiple compression.
Multiple compression essentially means the air gets let out of the balloon. If the market decides this isn't a hyper-growth AI stock anymore and reprices it to a normal PE ratio of, say, 30, the stock price absolutely collapses, even if the company is technically still profitable.
Exactly. And beyond the valuation math, there is massive competitive displacement risk. They are operating in a highly competitive, rapidly evolving landscape.
Right.
On the cybersecurity side, you have massive, well-capitalized giants like CrowdStrike and Palo Alto Networks fighting for every inch of market share.
Huge competitors.
And on the automotive side, there is a constant lingering threat that automakers might decide to pivot to open-source alternatives like Linux to save on royalty fees.
I have to lean into the skeptic role heavily on that competitive front. What happens if a massive player, let's say a Toyota or a Volkswagen, decides to hire 1,000 software engineers and just build their own proprietary operating system using open-source Linux?
A valid question.
If they decide to stop paying a royalty on every car, doesn't that instantly shatter the entire growth thesis?
That is the ultimate bear argument. If the automotive giants successfully build their own in-house systems, the QNX monopoly breaks.
So the huge risk.
However, the counterargument brings us right back to the technological moat. Standard open-source Linux is what is known as a general-purpose operating system. It is designed to be fair, giving processing power to all background applications evenly. QNX, though, is a deterministic, real-time operating system.
Meaning what exactly, in the context of driving a car?
Meaning that if the car's sensors detect an obstacle, QNX guarantees that the braking software will interrupt every other system and execute in the exact microsecond it is required to.
Oh, wow.
It is mathematically deterministic. If an automaker tries to save a few dollars per car by using an open source system, and a background application causes a half-second latency lag that results in a fatal autonomous crash, the liability to the automaker is devastating.
The lawsuits would be astronomical.
Exactly. Automakers gladly pay the QNX royalty because it acts as an ironclad insurance policy against catastrophic latency failures.
So putting all of this on the table, the massive technical breakout, the overbought RSI, the $950 million backlog, and the price for perfection valuation. What's the final verdict?
Synthesizing the fundamental turnaround, the upcoming macro catalysts, and the extreme near-term technical stretch, the data points to a bullish score of 7.5 to 8. The final stance is speculative bullish.
Breaking that down between time frames, how should someone view the immediate setup?
The short-term view is that this is a highly volatile swing trade setup heading into that critical June 25th earnings report.
Right.
Because the RSI is dangerously high at nearly 90, traders must respect the pullback risk and be aware of the technical support floor resting all the way down at $8.01.
And what about the long-term view for investors looking beyond June?
The long-term view is where the wealth-building context really shines. This is a multi-year structural play on a company attempting to become the irreplaceable safety layer for the physical AI revolution. It is backed by a near billion-dollar royalty backlog, a pristine balance sheet, and generative free cash flow that management is actively using to buy back shares. It presents an asymmetric opportunity for investors who understand the patience required for a long-term turnaround, but the inherent volatility makes it unsuitable for conservative income investors.
And as always, a clear reminder that this analysis is not financial advice. You must do your own research. And if you want a cleaner way to read trading charts to help map out things like that massive RSI overextension we talked about, check out VIP Algos through the link below in the description.
Yes.
VIP Algos is a TradingView indicator suite with visual buy and sell alerts, trend direction tools, support and resistance zones, and take profit and stop loss planning areas. It can help make charts easier to scan, but it is still only an educational chart analysis tool. It is not financial advice, it does not place trades for you, and it does not guarantee results. Trading involves risk, so always do your own research and manage your risk. This is an affiliate link, and we may earn a commission at no extra cost to you.
And if this episode helped you, please subscribe, like, and comment underneath. We'll see you in the next Smart Wealth with Joshua episode.
Think about that nervous system analogy one last time as you watch how this stock behaves in the coming weeks. A massive billion-dollar AI brain can dream and calculate all at once in the cloud, but without the physical reflexes to safely move the robotic muscle, it's just a brain trapped in a jar. Will this company be the one to finally wire up the physical AI revolution? Keep a close eye on June 25th.